Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. Well, the second quarter earnings reports are starting to come in, and there are projections of record profits for some companies. But are investors expecting too much, and is there danger of a bubble bursting? Also, which IRA should you invest in, a traditional IRA or a Roth IRA? My panel of financial advisors have their opinions, and it's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing are two of my panelists, and they are Carrie Coghill of Coghill Investment Strategies and also Michael Godwin of Fregasso Financial Advisors. Michael is the Chief Investment Officer for Fregasso, and if you couldn't tell it by now, Coghill Investment Strategies, Carrie Coghill, started Coghill Investment Strategies. Thanks so much for being with us once again for The Bull, the Bear, and You. Two of my regular panelists, Frank Rossetti of HF Management Company, could not be with us today, and neither could Kimberly Forrest of Boca Capital Partners. So we're going to proceed without them. All of the major indices are still solidly up for the year, and for the last month, the S&P 500 and the NASDAQ, they've been trading what I'm going to call a range or a zone, but since I don't have a technical analyst with us, we'll try not to project whether we're going to see a breakout to the upside or the downside. But perhaps we can take a look at some clues because we're now in the midst of the second quarter earnings reports. And according to Bloomberg Intelligence, second quarter profit projections for companies in the S&P 500 is 24%. That is a significant rise. Again, it's projection. It's not a fact. At least it is not yet. Possibly getting in the way of those projections are issues such as inflation, higher energy prices, and possibly higher interest rates. One advisor, quoted by Bloomberg, says investors are expecting sunshine and rainbows. And the headline in the Wall Street Journal states, "Are corporate earnings in a bubble?" So, Michael, I'll start with you on this one. Are investors expecting sunshine and rainbows, or should they be expecting a bubble to burst?
That's a lot to unpack, Stacy. Quite the long monologue there.
Sorry.
No, that's so. All right, sunshine and rainbows. So we have been in one heck of a bull market for a while, and I think investors always use past as prologue here, where the economic cycle, it should only be about 7-8 years, and then something's going to cause it to burst, and it drops, and that's just the way it works. And I'm not saying this time is different, but either it is different, or the cycle just continues to get longer and longer and longer. And maybe that's because of AI as well. What I think is very fascinating about the markets this year, 2026, right? The S&P 500 is up just shy of 10%, I believe, about 8-9% or so, which is pretty remarkable for the first half of the year. But all of that gain, all of it, and then some, has come from earnings growth. Stocks have actually gotten cheaper this year because earnings, as you mentioned before, have been so strong. And so if earnings continue to do the heavy lifting, which is what you want over the long haul, there's no reason to think that the bubble is going to burst. The bubble will burst if something regarding AI really, really has a downfall or a significant pullback. Right? This is starting to become a really AI-centric investment theme. Once it started with NVIDIA, now it's spreading out to the memory chips, certainly overseas as well. But you are also starting to see it expand into just other sectors of the economy, whether it's industrials, materials, energy stocks, etc. So long as that kind of continues, and if you think AI is going to be transformative, which we certainly do, sunshine and rainbows can continue. But we've seen it time and time again in years past. At some point, all good things come to an end. But what that looks like will be, I think, very, very unique at that one point. Doesn't necessarily mean it's going to be a 40 or 50% fall in the market. It just could mean that there's a correction back to normal market movements.
Well, I think that the market is priced to perfection, as we've talked, and so far earnings has supported the price growth that we have seen. But we always have to keep in mind that there are risks. And it's one thing to call something a bubble. And I don't think you really can call it a bubble if earnings are supporting the growth. But that doesn't eliminate the possibility for added volatility overall. So even though valuations, have when you look at it from a valuation perspective, stock prices have gone up, but valuations haven't gone up in conjunction with that. It still means that these companies are priced to perfection, and some sort of an external shock could cause some downside volatility in a more significant fashion with these companies that have grown so much. So it's really more about the sustainability of the earnings and the fundamentals of these companies and how they will handle changes in the economy and changes in the environment overall. So we're really watching leverage, because leverage is, always, I shouldn't say always, but it is a significant contributor to bubbles that have burst in the past and or added volatility in the market. So looking at corporate debt issuance, for example, we're up 28% year over year in how much debt that these companies are issuing, and really making a lot of investments into AI and into data centers. So we want to make sure that the fundamentals of these companies on the earnings side can continue. Having said that, as we're managing portfolios, when you're in an environment like this, it's the good old saying of sell high, buy low. So for our clients, this is a great opportunity to continue to rebalance and take some gains off the table. That may sound easy, but when you do that for a client in a taxable account, they don't like it so much because it means that they have to pay taxes. So as advisors, we're always walking that line with the client to communicate what the risks are. Do you want to maintain these positions and have added volatility in your portfolio? Can you handle that? Or do we pay the taxes and move on?
Yeah.
So those are the challenges that we really face.
All right, I don't want to belabor this subject, but all of you have kind of indicated about if there is a drop, especially in the AI. What if it's just a kind of a slow, not even a decline, but just I guess I'm thinking about another headline I saw in the Journal. I can't remember when it was. I think it was in the Journal that Hershey is priced more than Nvidia right now. If I'm not. Did any of you see that? I mean, basically, Nvidia is still making money, but it's not the hot one that it was. So maybe people are just beginning to accept some of the ramifications of how strong AI is.
Well, I think it's changing. It's changing very quickly. The players are changing quickly. Who your competitor is who your competitors are changes almost every day anymore. So, when you look at some of these companies that were really hot over the past few years, eyes are now going into other places in terms of which companies going forward are going to be what NVIDIA was, 5 years ago.
Okay.
You haven't seen as much since the Federal Reserve has gotten so involved in the economy and the market lexicon, following 2008. You've just seen more and more sharp drawdowns followed by sharp, rallies because the Fed just jumps in and they say, we'll cut rates or we'll do whatever. So you don't see those prolonged, longer, drawn-out periods. We kind of saw it in 2022 a little bit here. But again, there's the old adage, never catch a falling knife. And when you're going through it, you just don't know when the right time is to buy, right? If it drops suddenly, quickly, it could drop, the market could drop 15% in a matter of 5 days, and everybody thinks, it's going to drop another 20%, but that's sometimes a good time to buy. And Conversely, if it drops 20% over the course of a year, you never know when the right time is to buy into the market. Nobody does. If anybody tells you they do, hedge fund manager, Carrie, Coghill, Michael, they're lying to you. But what Carrie said before, I think, is very prudent. You have to have that. It's so cliched, and I've talked about it before. I don't like cliches, but you have your long-term plan. Stick with it, right? You have a long-term 70-30 portfolio, what have you. Those are the absolute best times to periodically rebalance your portfolio, and you're constantly buying back into those dips as the market sells off because you're rebalancing and you're doing a lot of good things there, regarding your cost basis and from a tax management and efficiency standpoint. It's very, very important to kind of do that. Have a plan to stick with it instead of letting your emotions dictate what you should be doing in the markets.
Yeah. It's
Okay. Yeah, go ahead,
I
Carrie.
was going to say the point about taxes is so important, and Michael mentioned that it's prudent to be taking gains along the way because aside from market volatility and stocks going down, the consequences of not rebalancing create a huge tax problem in the future. So for people that just want to hold and never take gains, at some point when you really do need to manage a position because it's gotten to be too large or the company's going through challenges, if you don't want to take gains today, you're not going to want to take gains in the future when they're even more significant. You're much better off, kind of taking gains along the way, not creating a tax time bomb, and looking for other opportunities in the market that can diversify the portfolio out. So, and to Michael's point, this is my 40th year. I got licensed in this industry in December of 1986. There has never been in 40 years a time where I've woken up and said, today's the day to get invested. Not in 40 years.
The Journal had another article concerning a demographer who basically says that AI might actually help solve the labor crisis. His projections are that by the end of this decade, 2030, almost 1930, 2030, that the labor force is only going to grow by 9 million. And by the 2040, we'll have a shortfall of workers in this country by more than 2 million. And so maybe all this fear about AI causing people to lose their jobs, it may, in the end, come to the rescue.
Well, I think the issue here is that anytime we've had disruption like we have with AI, it hasn't dislocated jobs. It's kind of been false. It just changes. And the jobs of tomorrow look very different than the jobs of today, especially given the dynamic that AI can cause everyone to be more productive. So that doesn't necessarily eliminate jobs. It eliminates certain types of jobs. But assuming it does, I mean, we do have a population crisis, particularly in Pittsburgh, by the way, when you look at, the demographics of our city. But moving forward, there's definitely a demographic problem and, it could shift, but I have a feeling that the jobs that are going to be created as a result of AI are going to maybe not solve that problem. Well,
so, Michael, if you're investing, and you guys believe in longer-term investing, if I'm not mistaken, if you're going to see a change demographically and AI possibly doing the work of the labor force that's not there, does that change how you look at a particular stock or stocks?
I don't know the answer to that. I don't think I could. I don't think I could answer that with a broad brush. To be honest with you, I think everybody's still trying to figure out or trying to assess how AI is really going to impact not only their own business. I'm sure Carrie's in that right now. We're kind of doing the same thing, but S&P 500 like companies in general, and then the broader economy in general. There was that research report that came out earlier in Q2, which set off the chain of events that rattled the private credit markets, that talked about 30% unemployment rates more or less, because companies from American Express to Coca-Cola to everything they're not going to need white collar workers anymore. But there's also a theory, and the theory is the wrong word, a paradox called Jevons paradox, where the better the technology becomes, the actual more demand that ensues from that, which means more workers will be required for that. You're kind of seeing that play out. Everybody thought radiologists would sort of go by the wayside a little bit with the advent of technology and whatnot. You're actually seeing more and more radiologists needed. You're seeing the same thing with call centers in India. Everybody thought call centers would be the first thing to go because of AI, and you have chatbots now, and you have automated calls when you talk to people. But you're actually seeing a more of a demand for call center employees, because now you can do with AI, you can actually reach more target audiences because of the technology, and that's demanding more and more workers for those things. So I don't think this is black and white as saying AI is going to, be super revolutionary. It's going to be able to do your job better than you. You're now no longer, you're more, you're dispensable now. So it's not as binary as I think it maybe once was, even 5-6 months ago. You're seeing this play out, and it's going to play out over years and years and years. And Carrie's right. Certain industries, certain jobs are going to get disrupted, but there's going to be a whole set of new jobs or new requirements that are needed to facilitate the advancements in AI. So it's really hard to paint a broad stroke, Stacy, in terms of how do we look at each company based on that at this point.
Yeah. I feel a little more strongly about it. I do think that it is really going to impact just about every industry. And when we're looking at companies, and we're looking at investing in companies that really are going to be able to deliver and be sustainable over the long run, it really does become a question about how is AI a competitor to them, and or how are they utilizing AI in their business? Because those companies that are applying and using AI and making adjustments in terms of how they do business, I believe will be the ones that lead the way over the course of the next decade.
Okay. Let's wrap this up with this particular question. And this, I'm not sure, Michael, whether you'll be much involved in this one, or whether it's going to be mostly Carrie here.
Thanks for the confidence, Stacy.
Yeah, well, that's fine. That's fine. I mean, you're a chief investment officer, so maybe this is it. I don't know. We get to IRAs. There's a traditional IRA and there's a Roth IRA. Which one should somebody go with?
Yeah.
What are there, or is there another vehicle that's even better than the IRAs?
Well, I think that looking at the whole landscape of what's available for retirement, your 401k plan, your IRAs, whether you're making Roth contributions to your 401k, because that also may be a possibility within your 401k. But just in talking about the differences between a traditional IRA and a Roth IRA, a traditional IRA, you get to deduct that contribution from your taxes, and that money grows tax deferred, meaning that when you pull it out, you pay taxes at your tax rate at that time.
The theory being, of course, that you're going to have a lower tax rate after you retire, right?
Right. Okay. And especially if you're in a high tax bracket today, you're not paying taxes on that money. Right. The Roth IRA, you don't get that tax deduction today, but it grows tax-free forever. So when you ultimately pull that money out, you're not paying taxes on it. The question and the answer really to should you have a Roth, should you have a traditional, even within the 401k, should I be contributing to a Roth portion if I have that option? It really comes down to planning. It comes down to understanding what your tax rate is today, what it might look like in the future. And also, it comes down to wanting to diversify your income streams at retirement. So it might sound great to take the tax deduction today and be all in tax deferred vehicles. But then if all of your income during retirement is going to be taxable, does that really make sense? So when we're doing analysis for clients, we're trying to project out to make sure that we're not causing a tax problem during retirement, even though it may appear that a client's going to be in a lower tax bracket, that might not be the case. So it's not such a straightforward answer. Younger people, it's a great vehicle, because if they're not in a high tax bracket today, getting some money socked away into something that's going to grow tax-free and never be taxed is really a great advantage.
So, Carrie obviously hit the nail on the head with that, and Stacy, you were right in regards to when you retire. The theory is you'll likely be in a lower tax bracket than you are currently now, maybe depending on where you are in your career. So the financial textbooks, the mathematical textbooks would tell you it's better to put your money into an IRA currently, take that tax deduction, let it grow over that period, and then be taxed when you take it out. Now, that being said, I don't follow that personally. I hate taxes. I would rather pay quite a bit of them now and then see where the dice rolls when I'm retired. So my 401k personally, I have it split down the middle. Half goes into a traditional IRA or 401k, and half goes into our Roth 401k. My theory being, we don't know where the tax rates are going to be when I retire in 150 years, whenever I retire. But I do know that the trajectory that we seem to be going on right now is they're likely going to be a little bit higher, given certain people in Congress and Senates that kind of are going that much more progressive route there. So I would rather at least have a bucket, as Carrie pointed out, of my retirement assets that are, tax exempt from that standpoint. So, but Carrie's 100% right. You like I said before, you can't paint everything with a broad brush. It absolutely comes down to planning, and again, another cliche, but everybody's planning is unique to themselves, and so you have to look at it from a case-by-case basis on what you should do.
And the Roth IRA can invest similarly as a regular traditional IRA?
Exact same way. Exact same investments. Exact same investments.
All right, good. I'm glad we touched on that. Well, thank you so much for joining us once again for The Bull, the Bear, and You, and we'll continue our look at investing in the economy on a future edition. Since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to use, but that does it for now. We'll see you again in a couple of weeks. Thanks again for joining us for The Bull, the Bear, and You.